Howdy, Jacob here. Today we're looking at Dayforce, a $9.3 billion market cap, $10 billion enterprise, founded in 1992. They operate as a human capital management software company internationally. Their growth has been somewhat impressive, but has been coming very heavy recently. The last 3 years, 21% revenue growth year over year. Before that, maybe they were averaging mid to upper single digits. Return on invested capital, gross margin, 40% range. Operating margin, they're having trouble trying to be consistent there, but their upper end is about 8%. Return on invested capital, not very high because, again, not making a whole lot of money off the revenue that's coming in. No R&D spend, so it's all just cost of goods sold, sales, general, and admin. And we did see a little bit of net debt here, big increase in shares over the last 7 years, not so much the last 4 or 5. Balance sheet shows $570 million cash on hand, $1.2 billion long-term debt, $8 million short-term debt. $1 billion in relation to their free cash flow seems quite high. They do have a good amount of cash on hand, though, so maybe if their long-term debt's due a little bit in 3 years, 5 years, 7 years, I think that's not terribly concerning to me. And it looks like they did issue debt to fund reinvestment and acquisitions. So I don't terribly mind that, especially because they did this big acquisition reinvestment. They did make a bit more money after that. So it could have made, or a lot more free cash flow after that. So it could have been a decent investment. $400 million. I mean, I don't know exactly where this extra 60 million, or what is this, 90 million of operated cash flow is coming from, but it did also increase capex a little bit. But again, we're seeing 2 years in a row of positive and greater positive free cash flow more recently. So you got to take more weight to the more recent data. So I feel pretty decent about that acquisition and the reinvestment. And I do like companies that invest back into themselves. Obviously, you want them to reinvest at high rates of return. So hopefully they're compiling that money, giving you an extra rate of return on it that's in excess of the market. For right now, I think I'm ready to make some assumptions here. I think for revenue growth, I mean, they've grown pretty heavily recently. I mean, maybe they'll be able to keep up with 10% revenue growth. They're a pretty big market cap company, but for revenue, I don't think they're that large. I don't actually know the size of the human capital management market, but I'm sure it's much bigger than this. As for margins, I think that this is kind of a story since they've been inconsistent, but maybe they're able to do 6 and 9 with share change. 1% is about almost 100 million. They issue that in stock-based compensation. So maybe 1 million or 1% increase of shares. Terminal PE, again, a lot of money through acquisitions, but they've been pretty decent with it. It's been hitting the bottom line, at least recently. So maybe we'll do 15% return. I mean, it just looks expensive to me. I mean, you'd have to really create a wild story here to make these numbers make sense. I mean, even if you thought it was going to keep growing at 20% and have 15% margins with a 25 PE, I mean, it's not even there. So I know I'm a bit conservative with most of my estimations, but for me, this is what I'm comfortable with. And right now, they haven't even they've gotten 9% once in the last 5 years. Outside of that, it was negative. And so I don't feel comfortable right now investing in this business. I think it's a fine business, but for me, I like longer term, a longer history of consistent profits, which I'm just not seeing. And so possibly my assumptions are a bit low, but that's what I'm comfortable with. Hope you enjoy the video and have a great day.